Bitcoin just broke its 6-week low, and the rebound may surprise you. Welcome to the Digital Finance Daily News Show, your place to stay informed in the high-speed digital world. As geopolitical tensions eased between Iran and Israel, Bitcoin surged from $101,000 to over $105,000 today. That's not just a reversal, it's a reset in risk appetite. Behind the scenes, a spooked market hit key support around $101,276 on the daily chart, triggering a $50 million short squeeze. That catalytic bounce now has Bitcoin eyeing major resistance zones at $109,000 and even $111,500 if momentum holds. The RSI on the 4-hour chart flipped bullish, with stochastic indicators confirming reversal strength. Volume profiles show increasing spot demand near the $103,000 mark, indicating accumulation, not distribution. On-chain metrics reveal long-term holders ramping up positions, while exchange outflows hit a 30-day high. But the bullish setup isn't just technical, it's macro-driven. The Fed's cautious tone on interest rates is creating volatility. While inflation is cooling, it remains above the 2% target, and Trump-era tariffs are back in the spotlight. If those tariffs expand, input costs could spike again, stalling disinflation. That forces the Fed into a corner. Cut too soon, inflation rises; wait too long, growth slows. Bond markets are betting on 75 basis points of rate cuts starting in September. That liquidity pivot could light a fire under Bitcoin, just like it did in March 2020 and again in late 2023. Meanwhile, the mining side of Bitcoin is under pressure. Over the weekend, U.S. airstrikes targeted nuclear-linked infrastructure in Iran. Several power grids were affected, knocking out key mining facilities. In just 48 hours, Bitcoin's hash rate dropped from 943 exahashes to 861, a steep 8.7% decline. That's one of the sharpest short-term drops since the China ban of 2021. Miner revenue per terahash spiked briefly as the network adjusted. And this isn't just a footnote, it's a real-time lesson in decentralization and resilience. Centralized energy grids are geopolitical weak points. This disruption proved that the Bitcoin network can absorb shock and recover without intervention. At the same time, we're seeing unprecedented institutional flows. BlackRock's IBIT pulled in over $1 billion last week, marking the largest inflow since launch. Fidelity, Grayscale, and Bitwise are also seeing positive flows. And now, ProCap Financial just announced a $1 billion Bitcoin treasury merger, mirroring MicroStrategy's early model but at sovereign scale. These aren't just ETFs, they're strategic moves by capital allocators preparing for long-term fiat volatility. Why now? Because central banks globally are showing signs of tightening fatigue. The ECB paused. The Bank of England is signaling dovishness. Japan just intervened in FX. And in the US, if job numbers disappoint, rate cuts are not just possible, they're likely. Bitcoin, with its fixed supply and uncensorable nature, stands out in that environment. Let's zoom out. Historically, Bitcoin reacts with lag to geopolitical events. In 2020, the Iran-US tension saw Bitcoin spike 10% in a week. In 2022, the Russia-Ukraine war led to capital flight into Bitcoin across Eastern Europe. Now in 2025, the Iran-Israel conflict and energy grid vulnerabilities are reinforcing Bitcoin's role as a geopolitical hedge. Add to that the weakening dollar, surging gold prices, and growing global debt to GDP ratios, and Bitcoin looks not just like a bet, but a necessity. The big question now: will Bitcoin hold above $105,000 and punch through $110,000, or are we setting up for another volatility trap ahead of CPI data and Fed minutes? Eyes will be on unemployment data, PCE inflation, and Treasury auction yields. Because in a fragile macro world, every data point moves the needle. Stay fast, stay informed. And don't blink, because Bitcoin's moment is unfolding right now. If you want macro crypto clarity every day, hit that like button, subscribe, and share this with someone who needs the edge.